Joining us now for a look at the potential market catalysts in the week ahead, Lindsey Piegza, Stifel chief economist, and Karen Kavanaugh, Carolina's wealth management chief investment officer. Lindsey, let me start with you. Why don't you tell us your expectation for Jackson Hole in the Fed chairman's speech on Friday?
Well, I think a lot of the conversation is going to be around inflation. You talked earlier about the Fed not wanting to declare victory, and in part that's because they haven't reached their 2% goal. Now, the Fed has made tremendous progress restraining price pressures off of earlier peaks, but the intention was not to get inflation down from 8% to 4%, but to continue on this downward trajectory to that 2% target. So I do think that the Fed has, again, reason to be confident that they're continuing to make improvements. But as we saw in the July FOMC minutes, even before the latest hotter than expected inflation numbers, there was still seen a significant upside risk to inflation. And so I do think that the chairman is going to emphasize the need for more work to be done and potentially resulting then in a higher for longer rate scenario.
Karen, is this an event as far as the stock market is concerned? Is it just sort of, is there only downside risk to the chairman talking here? Is there the idea that he's going to end up being hawkish and that's not going to be positive for the stock market?
I don't think it's that much of an event. It's not like it was last year where we were really looking for some guidance from Chair Powell. So this year, I think it's going to be a little bit more subdued. We are looking for Powell to really give us some guidance on how he thinks progress is working out with our fight against inflation. But I don't think that it's going to be as groundbreaking as it was last year. I think the market already knows that we still have a little ways to go in inflation. We've had stronger than normal economic data as of late. So I think the Fed chairman is only going to say what we already know.
Karen, are you advising clients that the Fed is going to stick the landing here, that it's going to come off that balance beam, it's going to be standing up, put its arms in the air, and get tens across the board here? Or are you more worried? Are you concerned like Joe is about the end here?
Well, I am concerned because that's not it's not easy to stick that landing as you were discussing. So, but I think that even if we do see a recession, it is not going to be severe. We do have some buffers. So we may see a mild recession. It's not off the table yet, but I think it's very difficult to kind of thread that needle and have a totally soft landing. We know that monetary policy has a 2-year lag, so we haven't seen all of the effects of what's going on with raising interest rates so much so soon, so quickly. So therefore, I'm cautiously optimistic.
Lindsey, I want to ask the same question of you, but I want to make it a little more economically geeky, perhaps. What does the Fed do with this idea that it brought down inflation by as much as it has since Jackson Hole last year? Unemployment has been flat, and GDP so far, this quarter, it's kind of running kind of crazy, and the last several quarters, it's been above trend. That has not comported with their forecast or their view of how the economy should work.
No, it certainly hasn't. And I think they underestimated a number of the artificial or superficial supports that were deployed during this unprecedented time, during the pandemic and in the immediate aftermath, that continue to artificially support the consumer and by extension, the broader economy. And so I do think that the Fed has underestimated the timeline needed in order to see the intended effects of tighter monetary policy. But that doesn't mean that weakness has been entirely deterred. It simply means that it's been deferred. There was an expectation that weakness would have come into play early 2023. That's pushed out to late 2023. Now 2024 is the expectation for that downturn. But that doesn't change the Fed's focus and the intention of tighter monetary policy, which is to raise rates, tap down investment, tap down consumption, and by extension, then eventually see that slowdown in top line growth, resulting in more benign inflation. So the Fed has been able to achieve a good portion of their intention, again, getting us down from 8% to 4%. But in order to reach that last 200 basis points, getting us back to that 2% target, the Fed will have to eventually tighten enough, reach that sufficiently restrictive level in policy to slow growth enough in order to see that more benign price level. So again, we're eventually going to see that downturn. We've just pushed that out further into the future.
Hey, Karen, it's Scott. I'm curious your take on where we are in the market in the here and now after a couple of rocky weeks. How at risk do you think stocks are?
Well, we in some of the high-flying names, we already have a correction. We're in official correction territory. And we know that seasonally this is a weak time for markets. But when I look at earnings, it's hard to be that bearish. I mean, we held our own on Q2. Q3 looks better. Q4 looks pretty darn decent. So it's hard to be that bearish. I think companies are telling us that they're resilient, consumers are resilient, the economy's been resilient. So even if we do have a downturn, it will be mild. Some of the China data is concerning, but that's already being reflected in earnings estimates. And the fact that guidance has really held its own in Q2 earnings season, I'm actually thinking that we can have a good end of the year for the market.
All right, just to recap, your story here is that it's the government and government spending that is responsible for the strength in the economy, and that eventually runs out sometime in 2024, and that's when the economy slows down.
Well, government stimulus was part of the artificial support, but
Sure.
we have to look at what the consumer's been relying on. They had a tremendous amount of savings. That was a stockpile of wealth estimated to be over $2 trillion. Now, we've drawn down a lot of that. As an alternative, consumers are now turning to credit cards, tapping into 401ks, this last sputtering of state and local stimulus or support coming down the pipeline. So there's a number of these superficial temporary supports that have allowed the consumer to remain resilient. But when we look at these spending patterns outpacing what we're earning, unless these supports remain indefinite, eventually we do expect that downturn. Again, it doesn't mean the consumer's falling off a cliff, but we would expect that weakness to set in, eventually resulting in that more benign pressure on the demand side, allowing the Fed to better achieve that 2% goal.